Hello Proponomics people and welcome to my video from Thursday the 21st of March 2024, and today is the Bank of England's Monetary Policy Committee meeting. Now I'm recording this video in the morning before the meeting, which is taking a bit of a chance. I appreciate that, but my interest rate predictions have been pretty good over the last couple of years, and I'm fairly convinced as I've been over this cycle, that today's meeting is going to be a hold. And I think that that's not a great prediction that anyone with a modicum of sense would be able to see that's the case if they spend any time looking at what the bank do, what the bank look at in terms of the decision metrics they need to decide whether they've got inflation under control, for example, which of course is their big remit. But I'm confident enough to record this video and release it before the meeting. It'll be quite amusing if I'm wrong and there'll be some egg on my face, but I'm happy to leave it up on the channel because that's the sort of guy that I am. So I want to go into a bit more detail in the video because the bank send messages really in two ways, and that sounds a little bit cryptic, but it's not necessarily that the bank wants to, but there's a big element of transparency in the committee, and the bank send messages by openly speaking about things, usually through the governor after a meeting, but there are other players on the committee who have influence and have a vote. And if you hold the same views towards the governor that I do, you'd suggest perhaps they're more influential. And I'll get into that a little bit as well. And also the vote itself. So just a quick recap, there are 9 members on the Monetary Policy Committee. 5 work for the Bank of England full-time, that's what they do. And 4 are externals or non-exec directors, if you're familiar with the parlance in private companies. They are external members of the committee, and they are some of the most eminent economists from around the world, really, that are interested enough to take part in the UK monetary policy setting via being on the committee and having an influence, and obviously having a bit of a mouthpiece as well, because when any of these ladies and gentlemen speak, people are listening and things happen in the bond markets. So that's important for property investors because that's what sets the mortgage rate. But this is more important in a longer term sort of way rather than today's or tomorrow's remortgages. I see this as important over a 5 and 10 year plus period. And if you're investing in property to hold, that's the sort of time period you should be working towards. If you're not, you should probably sell and put your money somewhere else because it's not a short-term asset apart from for the very talented property traders, people who buy and sell through auction and through cash buy companies, and the flippers. Although flippers, in my opinion, these days, due to all the frictional costs that there are, don't make a great return on their time, capital and effort. But hey, who am I to denigrate someone else's business model? So, as I said, 9 members on the committee. First of all, Andrew Bailey, the governor, used to run the FCA, was the top boy there. And of course, when you've made it to the top of any sort of public sector organisation, it's quite common you would transition to the top of another public sector organisation. That's what's happened here. I'm afraid I don't think too much of his economic nous, although I must say when I read the Treasury Committee minutes, when the bank, after the meetings, go and speak to the Treasury, he absolutely destroyed some of the government ministers in there. So he can't maybe as silly as some of my posts in the past and some of many commentators' posts in the past have made out. But the reality is he's not a preeminent central banker. He's not Mark Carney. You know, he's not even Jay Powell at the Fed. He's not Ben Bernanke. He's Andrew Bailey. And in fairness to him, he's come into a pretty tough gig. Should never have bought into the transitory line. That was always a bunch of guff. That was economists really not doing their economic history piece and having too much recency bias because we'd had lots and lots of low interest rates and they just thought, oh, this will just pop through the system with no real historical precedent for such a big shock ever popping through a system. And as soon as Putin's guys set foot over the Ukraine border, the writing was on the wall, realistically. It was more, how do we stop it? And of course, that freight train of inflation only really stopped because it was actually Liz Truss, who was in charge at the time, enacted the energy price cap of a cost of about 160 billion to the country. Interesting enough, no one ever really mentions that. They talk about COVID, they talk about furlough, they talk about all these other things. They don't really talk about the energy price cap. And I'm not saying it was a bad policy, because expensive energy is the single most damaging thing for an economy in terms of growth, in terms of even staying the same as where we were, and in terms of human life as well, because ultimately you had people, and we still have people, who haven't switched the gas back on since they've been scared the wits out of them in October 2022 by what was genuinely happening. We had 1,000% inflation plus in energy markets, hyperinflation genuinely, compartmentalised to there, but that fed through into 10% plus inflation latter half of 22, early part of 23, as you'll know. So on to the other members of the committee who work for the bank. So Sarah Breeden, Deputy Governor for Financial Stability. So there are three key roles that the bank really undertake: the control of inflation, monitoring the financial stability of the UK economy, and also monitoring markets and the banking sector. And Sarah Breeden is the Deputy Governor with the Financial Stability Brief. So there are financial stability meetings. There are a couple of those a year, and there are minutes of those. And I talk about those in the Sunday supplement and the videos that I produce on a weekly basis. Then there's Ben Broadbent, who's the Deputy Governor for Monetary Policy. So really the main person on the committee. And the reality is Bailey and Broadbent have never disagreed in a vote. And in my opinion, Bailey has simply followed Broadbent's role. Broadbent is very experienced central banker. Well over 100 times he's voted on monetary policy and speaks very, very well, very erudite, understands the situation. Not that he's not prone to making mistakes, because as I said, as a committee as a whole, I think they really let themselves down. But they would tell you that ultimately they used the predictions from the OBR and what the markets were doing. And they did, in fairness, say when the markets had got it wrong last year when they were predicting 6.5% base rates. Now, we're not out of the woods yet on that, and we may still reach a 6.5% base rate, although that would be a bit of a bloodbath style scenario and would take a few other things to go wrong. So don't panic, that's not a prediction, but that's got a probability of maybe 5%, but a raise from here is not impossible. And actually, just as a slight aside, Chairman of the Federal Reserve, Jay Powell, has effectively said yesterday, we might raise, we might cut, we might stay the same. It depends what the data's doing. But interesting, and listen to that language, we might still raise. Probably the truth. Whether the truth is what the markets want to hear, I don't know. But I suspect he might be trying to deflate that little bubble that's starting to appear in some of the stock markets worldwide, in the opinion of a lot of the analysts. I'm not someone who watches the stock markets incredibly closely. I take a passing interest. I've got some index fund investments. I don't get actively involved. I enjoy the idea of being actively involved, but that's enough for me. And then we have the Deputy Governor for Markets and Banking, Dave Ramsden. Sir Dave, again, super experienced, speaks very well, great understanding of what's going on in the incredibly liquid bond settlement markets that there are out there. And of course, the bank, whether it likes to or not, is always communicating with those markets and the market makers in those markets. Then we've got Hugh Pill, who's the chief economist. Now, he replaced Andy Haldane a couple of years back. He's also the executive director of monetary analysis. Solid economist, knows what he's doing. Again, really good understanding of the situation. A valuable member of any committee. Hasn't been someone who's particularly broke ranks much. You tend to find the deputy governors and the governor stick together. So I like to think of them as a bit of a core. And also the chief economist sticks with them. Now, there's all sorts of cynical reasons you could say for that. Those are the five that work for the bank. So they need to get on a day-to-day basis. They have not differed much in their voting. And I expect that core type five, as I would call them, to vote the same way today, which is to hold. Right? And then we're on to the externals. So Dr. Swati Dhingra, again, incredibly preeminent economist, very, very capable, very happy to be out on her own with her views. And her views are, A, central banking has to predict the future to an extent, which is correct. And B, it's time to cut rates, because in 6 months' time we'll be glad we cut rates because we're still going to feel that tightening. And C, consumption has been a problem, and it's been a problem because people haven't got confidence in the interest rate. So she thinks we need to send a message to consumers because consumption is so important for economic growth, and that message should be, we're cutting. I'm sure the Conservative Party would love to hear that, because a bit of loosening on the policy wouldn't do them any harm in terms of their waning general election chances in the election that's coming up. Then we've got Megan Green, relatively new member of the committee. There hasn't been loads of time to get to know her yet. American, again, phenomenal economist. The one who I really agree with the most, just from a voting pattern perspective, and when she speaks, I really listen. It very much is in line with my thinking. So she voted to raise 2 meetings ago, but last time out voted to hold and said that enough had been done for her vote to move from raise to hold. I think she votes hold again today. I think Dhingra votes cut again today, which only leaves 2 people, 2 curveballs, 2 hawks, really. First one with Jonathan Haskell, very experienced professor at one of the London universities. Can't remember which one off the top of my head, but again, speaks very well, very lucid, tells you exactly why he's thinking the way that he's thinking and what he's waiting for in order to vote cut. And I don't think he will have seen that as yet in the figures. Inflation down to 3.4, great, still well above target. Core still over 4%, over 4.5%. Services inflation still 6.1%. Wage inflation still 6.1% ex bonus. This is not cutting territory as yet, folks. Numbers like 4s and 6s, they're just too high, right? If we were just looking at CPI, I could understand it, but we're not. We've got to look at the component parts of CPI, and we've also got to understand the amount that's fallen out of CPI because energy prices have been coming down and are going to continue to go down. So that leaves Catherine Mann. I would describe her as the hawkiest of hawks. So if Haskell is still voting up, in my opinion, Mann is still voting up. Again, really great external member of a committee. Absolutely thinks on her own. There's no groupthink worries or anything about Catherine Mann. Very experienced economist. Again, American. Often harks back to experience within the American Federal Reserve. So that's 2 Americans we have who both lend their international experience to the Monetary Policy Committee. And probably just to round this video off, I'd like to say I think it's a great thing that we have an external independent central bank. Now, I have posted recently about the fact that the Deputy Governor, Ben Broadbent, comes to the end of his term in July. He's being replaced by someone who's currently consulting to, or is a member of Jeremy Hunt's inner team, working for the Treasury at the moment. And she does look like a bit of a mole of an appointment, if I'm honest with you, as the Deputy Governor. I'm fairly confident that when she comes in, that she's going to be, her name's Claire Lombardelli, by the way, when she comes into post, she's going to be voting downwards. And I'm pretty sure Jeremy's going to shift her onto the committee, because when new appointments are made to the committee, they are made by the Prime Minister and the Chancellor of the Exchequer. So let's not get too carried away when we say independent central bank. But my point would be, subject to like a recent article in the Telegraph which said get rid of the Bank of England's independence. I'm not sure they remember the 1990s very well, but if they go back and study a bit of their economic history, if they're not old enough to remember, it was an utter bloodbath where rates had to go up to 15% in one day to try and control what was going on in the bloodbath as sterling was leaving the exchange rate mechanism. And then within a week, that base rate was cut from 15 to 8.875. I mean, utter embarrassment. And all it showed you was the people involved were clueless and they just didn't understand what people like, for example, George Soros, they didn't understand what a short squeeze was. They didn't understand anything like that. And they blew off billions and billions of pounds worth of the value of sterling, tens of billions, if not hundreds of billions in the long run, did international reputational damage and made a complete mess. This committee and this bank would not do that. In fact, when we had a referendum with a surprise result in 2016, whether you agreed with it or not, it was all carnage and up in the air in the morning until Mark Carney came out and gave a speech about a very quick decision about cutting rates and settled the markets right down. And everything pretty much went to, in a way, business as usual. We were in overdrive about speculation for 4.5 years, all sorts of things going on, proroguing Parliament and all the rest of it. But when you put the noise to one side, we carried on as an economy. We didn't have a recession. We only had a very brief recession when COVID came, a technical one, 2 quarters of negative growth, one of them massively down, Q2 of 2020, because again, bit of a bloodbath. And then, of course, we've had this technical recession just now, although it very much looks like we're 99% of the way out of it. And if nothing major happens in the next 10 days geopolitically, I think we can safely say we're out of that recession. But that's a summary of the Bank of England Monetary Policy Committee. I'm not too aware of too many places that keep a close eye on the MPC, which is exactly why I have to do it myself, which is annoying because I have a lot of other commitments to consider as well. But maybe this video gives you a bit of insight into just how much time, effort and research I put into understanding the individual players. And when that vote comes through and the economic consensus is it'll be 7 hold, 1 up, 1 down, I'm going 6 hold, 2 up, 1 down. And if I'm right, then the bond markets, the yields will fall slightly because that will be different from the expectations. And the reason why they will fall slightly, in my opinion, is because it will be a slight surprise. And what that says is if Haskell and Mann are still where they are, we are going harder for longer, higher for longer on the rates, which is something I've been saying for such a long time now. I'm boring myself by repeating it, but that's where my view is. If it is 7-1-1, I wouldn't expect the yields to change too much because I expect that to be baked in. If we get a second vote to the downside, a breakaway from one of the core, because it is going to take one of the core, I can't see Megan Green changing her position this quickly to down, and I'd be knocked over with a feather if Haskell and Mann voted down today. It's just not going to happen. Then it'll have to be one of the core breaking away. Most likely to break away, probably Hugh Pill, because he's got the easiest remit politically within the bank to do that. But I can't see it happening personally. So I think 6-2-1. Bond yields fall slightly because what the message is that higher for longer and dreams of a June cut will be in tatters by the end of the day, potentially, although that's still 3 months away and things can happen. And we've got 3 more months worth of growth figures, unemployment figures, wage figures, and of course, inflation figures to be released before that meeting. So that's my views on today's meeting. I'm going to release this before 9 a.m. to prove that I've recorded it before the meeting, and hopefully there's at least a bit of entertainment either way. Thanks for listening.